Okay, so now what happens in an existing business if we want to admit a new partner? So there's two ways you can admit a new partner. They can purchase an interest from an existing partner, or they can invest cash or some asset or something into the partnership. So let's look at purchase of an interest in a partnership. Here, the purchase of a partnership interest, and this is right here, this is very important. The purchase of a partnership interest is a personal transaction between one or more current partners and the new partner that involves a reallocation of the capital of the current partners who sold their portion of the partnership. Okay, so let's make some sense of that. So assume that at the end of Landing Zone's third year, so David Breck has a capital balance of 20. He sells 1/2 of his partnership interest to Chris Davis for $18,000 on January 4th. So if he has a $20,000 balance in his capital account and he's selling 1/2 of that for $18,000, so that means he's selling 1/2 of the 20, that's $10,000. So his capital account decreases. We debit by $10,000, and we create a new capital account, Chris Davis, and we increase that by $10,000. You notice that Chris paid $18,000, but that was paid directly to David. That has no impact on the business. The only impact on the business itself is the capital account. However much he paid for that is paid personally to David, and it doesn't affect the business at all. So before the transaction, Olivia had $52,000 in our capital account. David had 20, and there was $72,000 total equity. January 4th, David sold half of his, so he sold $10,000, which leaves him with $10,000 remaining, and Chris purchased the $10,000, which leaves him or her, I'm not sure, with $10,000 remaining. So there's still total equity of $72. That did not change. Olivia's stayed the same, but David went from 20 to 10, and his 10 went to Chris. So that's how that one happens. The other alternative is you invest assets in a partnership. So this one, admitting a partner by an investment of assets, is a transaction between the new partner and the partnership. The invested assets become partnership equity. So whereas the other method was a transaction between the partners themselves, this is between the partner and the partnership. So to illustrate, so Sang had $52,000 interest, Breck had $20,000. They agreed to accept Davis with an investment of $28,000. So this person is investing $28,000. So we're assuming here it's cash, I guess. So we're increasing cash, debiting cash by $28,000, and we're increasing the capital account of the new partner by $28,000. So originally, before the transaction, there was total equity and net assets of $72, which was broken out by $52 to Olivia and $20 to David. After January 4th, or the January 4th transaction, will give Davis $28,000. So now we're adding $28,000 to equity and $28,000 to assets, because assets, equity, adding $28,000 to each. So now the total after the January 4th transaction is now, instead of $72,000 in net assets, we added 28. So now there's $100,000 in assets, and there's $100,000 in equity, and that's broken out by $52 to Olivia, $20 to David, and $28 to Chris. Okay, so next we look at the section bonus to old partners. So when the current market value of a partnership is greater than the recorded amounts of equity, the partners usually require a new partner to pay a bonus or premium for the privilege of joining. So So that exists with the example they gave her when the market value of net assets exceeds their book value, which is often the case once the partnership is established and has customers and a proven track record. So, the example. Let's say Sang and Breck agree to accept Davis as a partner with 25% interest in the landing zone, but they require Davis to invest $48,000. So, Sang had already invested $52,000. Breck's equity was $20,000. So, equity of existing partners, $52,000 and $20,000, $72,000. Investment of the new partner, they're asking her to invest $48,000. So, a total equity then is $120,000. They're giving her 25% interest, so 25% of $120,000. They're giving her $30,000. Her interest equates to $30,000, but they're asking her to pay $48,000. So she's paying $18,000 extra. That is the bonus or the premium, and that gets allocated to the existing partners. And again, they could have an agreement of how it's to be allocated. Here they're saying it's 50-50. So the entry, you're going to increase cash, so debit cash $48,000, and you're going to increase each one of the partners' capital accounts. Chris's account is going to be increased by the portion that we calculated here, $30,000. The $18,000 then gets split between the two remaining partners because it was 50-50, so theirs get increased by $9,000 each. So again, just a quick rundown. This is what was here before. The January 4th transaction then, we get $48,000 in assets, which would be cash, $48,000 increased in equity, and the increase in equity is split between $30,000 for Chris and $9,000 for the remaining two partners. There's another thing that sometimes happens where existing partners can give a bonus or premium to a new partner so that the new partner gets a larger equity in the amount invested. This usually occurs when additional cash is needed or the new partner has exceptional talents or business connections. So to entice that person to join their partnership. So here they agreed to let Davis in as a partner with a 25% interest, and they require Davis to invest only $18,000. So like before, the equities of the existing partners were $72,000, the new investment for $18,000, so total equity is $90,000. 25% of the $90,000, so Davis's share then of the business equates to $22,500 in their capital account. They're only paying $18,000, so they're paying less. So Davis is receiving the bonus in this case. So to account for that, cash is increasing by $18,000, what the person is paying $18,000, but the new partner Chris, their capital account is being increased by $22,500. We're going to credit $22,500, and then because they're receiving the bonus or the premium, the other partners' capital accounts get reduced by, and we said the ratio was 50-50, so they each take half of the $4,500 and they reduce their capital accounts. So again, we can see what's happening. Originally, this is the same as the prior examples, but now because of the January 4th transaction, $18,000 increase in assets and an $18,000 increase in equity. That increase is split between the new partner getting a $22,500 increase and the remaining partners decreasing their interest in their capital account, or decreasing the amount in their capital account down less than what it was previously. What happens if one of the partners wants to withdraw from the partnership? So there's two ways. One we already looked at. The withdrawing partner can sell his or her interest to another person who pays for it in cash or other assets. That's what we looked at in the prior section. A second scenario is when cash or other assets of the partnership are given to the withdrawing partner in settlement of his or her equity interest. So we're going to look at that now as an example. So this is where we start at. There's three of the three partners now. Olivia at 84, David at 38, and Chris at 38. This is where we're going to be right before Beck withdrawals. So Beck, here he's going to withdraw with no bonus. So he receives exactly the amount of his investment. So 38's in his capital account. So we debit his capital account and credit cash to account for giving him $38,000 in cash. And now his capital account will have a zero balance. Bonus to remaining partners. Here he's going to receive $34,000. So we zero out his capital account. So we $38,000. He's only receiving $34,000. So now, because he's receiving $4,000 less, the remaining $4,000 gets split between the other two partners, and that was already a decided, I guess, agreed among percentage. And the other partners share in this, and they increase their capital accounts by this amount. So that's a bonus to them. That might happen. The person that's leaving might be willing. My headset is falling off. Sorry. The person that's leaving might be willing to take less. Maybe they know that some of the assets are overstated. For whatever reason, they're willing to take less than what's in their capital account. The third scenario is if there's a bonus to the withdrawing partner. So maybe the partner, maybe they want to get rid of a partner, so they're willing to give them something to get them to leave. So here they're going to give them $40,000. So again, his capital account had 38, so we're reducing his capital account down to zero. We're giving him $40,000 in cash, so we're crediting cash. The $2,000 difference is split between the remaining two partners, and they are reducing their capital accounts by $1,000 each. So that's the three possibilities, or three ways that a partner can leave the partnership. All right, so what happens when they want to liquidate a partnership? We want to end it. So there are 4 steps that happen. Non-cash assets are sold, and then there's either a gain or loss. The gain or loss is allocated to the partners. All liabilities are paid, and then any remaining cash is distributed to the partners. So there's 2 scenarios. And the first one is there's no capital deficiency. That means all partners have credit balances in their capital accounts before the final distribution takes place. So let's look at this example. So to further go along with the same company, they've operated the landing zone for several years, and they share profit and losses equally. On January 15th, 2022, they decide to liquidate. So here's where everything is before the liquidation. So step 1, sell all non-cash assets for cash and record the gain or loss. So they sold all of their assets for $46,000. So cash increases $46,000, and then their assets, sporting facilities $33,000, accumulated depreciation of $18,000, and land of $25,000. That's their assets that they're selling. So we debit depreciation to zero that out. We zeroed out our sporting facilities and our land. With all of this, we end up with a gain from liquidation of $6,000. The next step then is we have to allocate that gain to the partners, and it's set up above. It was allocated equally. So now the gain on liquidation has a credit balance. We debited $6,000, and that $6,000 gets split between each of the 3 partners. Next, they have to pay any liabilities, and the one here is accounts payable for $20,000. So they pay out their whatever they have left in accounts payable, which reduces their cash. So now we can see where everything stands. So this is the information from above, where they were originally, and we're going to run out of time. So I'm going to stop right there, and we're going to pick up and do the last little section.